So we are moving swiftly now to our first company. It is reopening a historically high-grade gold district in South Australia. It recently lifted its resource estimate for its Tunkillia project to 1.5 million ounces. Now, the company is Barton Gold. It's listed in Australia, Frankfurt, and the US. The board hold a fifth of the stock. There's a reason they're doing that. The founder, the chief executive and managing director is Alex Scanlon. Try not to be too formal there. Thank you, Alex.
Thank you, Sarah. It's a pleasure to join as always. I will bring up and share our current presentation, which I'm actually delivering tomorrow at the London 121 conference. So very, very fresh. For those of you not familiar with Barton Gold, we actually, and I have to give a tip of the hat to Charlie. His entree to what's happening in the gold market right now is very much the same basis on which we built our premise around large-scale gold investment in a tier one jurisdiction. Before we get into the presentation, this image here on the cover is actually an image of a high-grade open pit that we have, very shallow, very accessible, and something that will come into play for us in the near future. But from a very high level, who are we? What are we doing? Why are we doing it? We are a pure play gold developer in South Australia. So we set about acquiring a very substantial ground position in Australia in tier one geology, tier one jurisdiction in terms of law, and then also tier one workforce. And we really settled on South Australia because as a state, it's very interesting. Within Australia, obviously Australia is very well known as a gold producing jurisdiction. South Australia actually contains about 25% of Australia's known gold resources, but speaks for only about 2.5% of annual production. And that's really a legacy of very heavy investment in an IOCG belt around Olympic Dam. So the world's probably now second biggest everything deposit. Everyone's very familiar with it. And for about 30 years, people have been investing very heavily in trying to find the next Olympic Dam. Well, BHP is now consolidated that belt, and that belt sits over a mineralized basin, which is basically fueled by granite intrusives. And on the east side of that basin, the mineralization is deep and coppery, and that's where you have Olympic Dam. But that same basin moves to the west and becomes shallow and gold, as a matter of speaking. And in that particular area, you have a 130-year-old high-grade producing gold district. We spotted this. We did a lot of due diligence, and we basically bought the district. So we bought every significant historical exploration and production asset. We bought the only gold mill in the region. And then we set about building a much larger platform for a much larger development. So our strategy there has been threefold. One, established a really large-scale baseload mineralization that we've done at our Tunkillia project. Two, shift to complementary high-grade drilling. Targeting high-grade assets because we can blend that with our existing bulk open pit mineralization, but also use that to leverage our existing infrastructure. And this is how we get from being a so-called explorer developer into a producer with relatively low cost, relatively low risk, and sort of a stage progression. So I'll explain that in greater detail. But the short summary is we have been very successful in doing this. The past 12 months have been very exciting for us. We have done everything from selling golds to having 3 different resource upgrades. We've had a number of different institutions join our register, some as substantial shareholders. We have started scoping studies on that large-scale Tunkillia project. We have high-grade drilling, that is high-grade target drilling, which has started actually yesterday in that neighboring high-grade gold field. And we are very, very well capitalized to continue doing all of this and really drive some interesting innovation during 2024. So looking at our capital structure, we have a pretty simple, very clean capital structure, about 218 million shares on issue. In capital, sort of market capitalization terms, we're about 70 million Australian dollars with an enterprise value in the sort of mid-50s once you factor our gold, our cash, and also our gold and concentrates. So we actually produce gold concentrates from existing stockpiles and materials and selectively sell those because really limited the amount of capital that we raise publicly. That is what has helped keep us help us keep a very constrained capital register. And what we've seen over the past 18 months in particular, as we've converted our geological premise into new discoveries, new resources, is in sort of a steady progressive matter, is a very strong consolidation of the market, both in terms of the institutional participants and retail participants around our story, around strong management alignment, strong consistent performance. And therefore we've really dramatically outperformed both the gold price itself, as hopefully we should, being a leveraged and riskier version of investing in gold. But we've also dramatically outperformed even the major producers indices like the VanEck Producers Indexes. So it's been going very, very well for us. We're hitting sort of new all-time highs just as we're actually shifting into some perhaps much more exciting and valuable elements, being scoping studies or economic studies and our high-grade drilling. When we think about the capital structure of the company, we can't forget the human capital. That is the most important part. We have built a team that reflects our future ambitions. So we have, just in our leadership team, well over 200 years of experience exploring for permitting, financing, developing, operating, and optimizing mining assets with a very strong pedigree both in gold and in South Australia. And those of you who remember your gold M&A history may remember that while today Newmont is buying Newcrest, 22 years ago, Newmont bought Normandy Mining, and Normandy Mining was the Southern Hemisphere's largest gold producer, and one of the largest in the world at that time, producing about 2.5 million ounces per annum. So we have basically rebuilt some of that core team. We have a lot of Normandy and Newmont names in our team here, and we've got a lot of proper mill development and operating expertise as well. And as I mentioned, this is really shaped towards that aspiration. We don't have a board and a management team that just reflects a driller, explorer. We are a developer. And so this big picture, to bring it together, that ambition is for us to take these assets and turn them into a 150,000 ounce per annum producer. Now, what are we focused on in doing that? So where we are really focused is our Tarcoola and our Tunkillia projects. And you sort of see these in the sort of bottom right of the map. These are two assets that together, and they really do operate together because they're 70 kilometers apart. So functionally, they're really one project in long-term development. But together, we have about 3,000 square kilometers of ground there. So this is a huge ground position. We have over 100 kilometers of major structures, and on less than 2% of those of that strike, we have now mapped out 1.5 million ounces of data. So we've really established this long-term base from just a very small part of that sandbar, so to speak. And what we're focused on is open pit mineralization. Open pit mining is faster, easier, cheaper, and safer to explore, for, develop, and operate. And our strategy is threefold. And we sort of work back to front in that strategy. We want to establish a long-term company-making project. So we're looking for large bulk open pit mineralization, something that can be very capital and operationally efficient. And then we want to supplement that with higher grade blending material. So we start with strategy number one. This is where we have built this Tunkillia project of ours up to 1.5 million ounces. That has now moved into the development stage of planning. That's now just started scoping studies. And we are now up and drilling in that Tarcoola gold field. So this was actually the home of high-grade gold in South Australia, which I'll explain a bit more in the coming slides. And the idea here, what's really interesting about this is, because these assets will eventually operate together, eventually high-grade material from Tarcoola will blend into full low-grade material from Tunkillia for a very, very compelling combined operation. But Tarcoola has also processed through our existing central Gawler mill. So that mill you see in the top left corner of this map has processed this material during 2017 and 2018. Very, very strong recoveries of about 93 to 94%. So we have proven logistics, proven metallurgy, and proven fully licensed infrastructure. So as we now drill up and sort of demonstrate or prove a series of high-grade resources at Tarcoola, we can actually utilize that to bring forward operations using the existing mill. And instead of trying to go from 0 to 150,000 ounces per annum by developing Tunkillia, we could start with Tarcoola, our existing infrastructure, and for the cost of a mill recommissioning, we can go from say 0 to 100 to 25,000 ounces to 50,000 ounces, and then use that to actually internally fund our expansion to 150,000 ounces. So Tunkillia becomes an expansion project, and Tarcoola is sort of a step ladder that takes us there in a much lower cost, much lower risk basis. Now, it's really important to understand why we are focused on bulk open pit mining. Why did we anchor around Tunkillia and the strategy and not just jump towards the more selective high grade? And the answer is that bulk open pit mining is better and cheaper than anything everywhere all the time. Volumetric capital and operating efficiencies are the key to low unit costs and therefore high profits. And we profile Capricorn Metals here, it's another Australian listed company, as a perfect example of this. This is the team that's literally made a career doing this systematically across very well-known bulk open pit, sort of 1 gram ore bodies. And they acquired their Karlawinda project back in 2015 as a 650,000 ounce asset. They grew that to 900,000 ounces, and then 1.1 and 1.3 and 1.5 million ounces. And then they really focused on scoping that as a bulk open pit, sort of volumetrically efficient operation. They have since grown that to about 2.2 million ounces, but importantly at a resource grade of 0.7 gram per ton. So something that we might traditionally think of as low grade, or particularly in a commonly underground high grade setting. However, they now run that as about 4 to 4.5 million ton per annum operation. They are producing 120,000 ounces per annum with a head grade of 0.8 to 0.9 gram per ton. And they are regularly one of the lowest cost gold producers in Australia. So producing for between $1,300 and $1,500 Australian, or about $850 to $1,000 US. So really instructive. And we saw in our Tunkillia project some indications in the data of similarities to Karlawinda. So our timeline is below the Capricorn timeline here. We acquired our project about 4.5 or 5 years later as a 550,000 ounce asset. We grew it to 900,000 ounces. We found 5 new gold zones, and then we systematically grew it to 1.1 and 1.3 and 1.5 million ounces. So following almost a stunningly identical progression there, and now are moving it into the same large scale development study. So we're following the leader, so to speak, in this, and we're doing it quite well. And we think the way that this is looking is going to be very interesting. So this is the Tunkillia project. When we originally acquired it, we acquired essentially this sort of dark blue central mass of the main deposits area there. And we first validated our theory that there was a higher grade central zone in the middle, and then we extended that to depth twice, and then we found 5 new gold zones and have since converted 4 of those into new resources. So that now takes us to 1.5 million ounces there along the western margin of the shear zone. We have done that quickly, we have done it reliably, and we have done it cheaply. So our cost per ounce of discovery or resource growth has been about $15 Australian on an all-in basis. So a true all-in costs, drilling and assay and consultants and logistics and labor and everything. Very, very, very efficient cost of growth. But this is really for us just a longer term starting point. We have another 20 kilometers of untested shear here. This is now moving with development studies. And what we're looking at there is a really attractive development geometry. So this is where I get quite excited as a financier and an economist and a numbers guy. The majority of our ounces sit within 200 meters of surface there. And we also have this central high grade core. So you have to start a big bulk open pit somewhere. The cross section on the right hand side of the screen here shows you what we're looking at in that central high grade core. And what that is, in some words, is about 100 meters of mining width. So this is a football field long and wide in terms of mineralization. And about 20 to 30 meters of that has a higher grade core with some mineralization grades between 2 and 10 grams per ton. So really ideal central higher grade pit. And then as we open that to the north and the south, this light blue sequence that you see, which looks like a T-zone in this cross section, is shallower, softer, oxide and transitional mineralization. There's about 250,000 ounces that will pay us to do the pre-strip as opposed to us paying to do the pre-strip. So that that makes for some very attractive figures. And then everything that we're looking at with Tunkillia is just in that green box. We think the potential here for this to be a much larger district is considerable. And if you had a district of both open pits operating, you would love to have high grade gold nearby. That is where we then look 70 kilometers north, back to Tarcoola. Again, this is the home of South Australia's entire gold history, in particular its high grade gold history. In the southwest corner of our tenements, there is the historical Tarcoola gold field. The gold was discovered in 1893. People were mining gold from shallow structures there at 30, 40, and 50 grams per ton during the early 1900s. And then 100 years later, somebody put a shallow open pit around one of those shafts and produced another sort of 30,000 ounces at 3 or 4 or 5 gram per ton bulk grade to our mill. So we have stepped back and said, what is the series of events or occurrences? What's the system that fed these sort of 600 historical high-grade workings? The pit itself that you saw on the cover is very interesting. This is complex geology. We have found a whole bunch of high-grade drilling intercepts around it, but we've actually just drilled the pit floor because we have a walk-up and restart open pit. Even if we just put 20,000 ounces in that pit, that is essentially year one of our stage one strategy. But where it gets really interesting is we say, consider the incredible value that came out of this tiny little pit and step back. In parallel with growing Tunkillia to 1.5 million ounces, we've spent the last 2 to 3 years building a new regional structural model. We published this in November last year. This is the first time in 130 years of high-grade production that we can actually see all of the subsurface structures. And it's the first time that all of this historical high-grade production fits in a consistent structural framework. Yesterday, we started drilling about 7 different targets across this for repeats of that high-grade mineralization. So very exciting times for us. The past 12 months have been very exciting. We have sold gold. We've had 3 resource upgrades. We've had 2 different rounds of institutional investors buying into our story. And looking forward, I think 2024 is going to be a very exciting year. We will be putting out scoping study results soon. We will have nonstop high-grade target drilling. We will be selling more gold, and we'll probably have a few more resource upgrades. So we, in and amongst the market, are a pretty unusual proposition. We have a very strong platform. We are growing it quickly. We have a very clear pathway to development. And really this combination of strong platform and reliable, steady performance, and really what we would propose represents true value to investors. And in fact, you know, our investors who are with us now, we're typically the #1 performing junior mining company in their portfolio by a considerable margin. So we will endeavor to do the same going forward, and certainly very happy to answer any questions that you may have.
Many thanks, Alex. So you just said there, non-stop drilling for high-grade targets. Do you have the utilities to support that statement? Non-stop drilling?
Correct. Yes. So we basically are not limited by terrain. We're not limited by infrastructure. We're not limited by capital. We're not limited by drilling availability. One of the great things about where we are is we are in wide open flat terrain. So we aren't drilling in deep mountain ranges where you have the helicopter rigs in. We have, you know, year-round drilling. We have about 13 million worth of cash and gold, and we have regularly 5 to 10 drilling companies that are always bidding to do our work. So for us, it's really been a case of building up this target set as quickly as possible, and now we're going to be going out and testing them as quickly as we possibly can, trying to, you know, convert those of the highest promise into new gold zones, and then aggressively following that up to convert those into resources, create that base load, and basically justify pushing the green button to restart our mill and shift into production.
So you spent a lot of time explaining to us why open pit, why you have a laser-like focus on the open pit operations. Now, Lord Ashbourne was talking about the potential for price movements within gold. So I'm just wondering, when the price of gold alters, does that change the baseline economics of the projects significantly?
It does. I mean, obviously, the gold price is your primary leverage to unit economics or unit profitability is the gold price. This field that we're looking at now, because of the nature of its geology, we believe it will create a field of high-grade open pits that would likely in the future become a series of underground mines as well. So you always would, obviously do your economic analysis to determine which, if any of these, would you want to go underground, on what production scale, and why. But obviously, as the gold price goes up, that proposition becomes more attractive. The thing that is difficult with underground mining is that you are very constrained, right? So you have a development like, I'll explain this in the context of a somewhat silly saying, but there's this saying about sucking golf balls through a garden hose, right? You can only move so much through an existing port. And so you don't have the ability to respond to input cost pressures in an underground mining environment the way that you do in an open pit environment. In an open pit environment, you can adjust your equipment sizing. You can move more and less material, and you can kind of see everything all at once while you're mining. In an underground environment, your relationship with the mineralization is often just the walls right in front of you, and you have no choice but to slug it out with the economies of 1 cubic meter at a time. And if your costs double or triple in developing that meter, life can get very difficult when it actually comes down to the profits. So it is more favorable to at least start and control your baseload production with open pit.
Many thanks. Alex, we're just losing your sound now, so this is probably a good time to say thank you very much indeed. We really appreciate it. Lovely to get an update on Barton Gold, and I hope the next 12 months are as successful as the previous 12 months. So yes, you're welcome. Yeah, mineral resources upgraded 3 times during the past 12 months. That is quite significant indeed. Alex is currently at a mining conference in the UK, and he said that the energy is very different to what he experienced 12 months ago. So to me, that is a positive.